All right, so we're doing something completely new in this video, and I just want to make these videos as impactful as possible. Now, I did deal with the hurricane, so I'm sorry for the inconsistent upload. It was pretty brutal, but we're all okay. We now have power. So let's get into exactly what's taking place today. I want to start ranking stocks based on price action every single week and opportunities that these stocks have. And if you like this type of material, consider subscribing. Welcome into Compounding Capital. And stock number one is a very interesting stock. This is going to be a higher risk, higher reward. Now, for the record, I want to make it clear that this is not financial advice. These are just stocks that I'm personally looking at and could be adding into the portfolio very soon. Number one's going to be Rio Tinto. Now, Rio Tinto is pretty fairly valued, I think, at these levels. And when we look at what they're currently doing, why all of a sudden am I interested in Rio Tinto? They have a well-diverse portfolio in mining in aluminum, copper, and iron ore. And after this recent acquisition, is going to be the second largest producer of lithium, just behind Albemarle. Now, I've done valuations on Albemarle, and between $75 and $80 seems to be fair price. This is a stock that shot up extremely high, now is completely depressed, very, very volatile. So when I look at the opportunity of Rio Tinto, not only does it have the ability to absolutely explode on revenue growth if lithium is really going to be in high demand, but it has a well-diverse portfolio and pays a nice dividend. As of this recording, the dividend yield is sitting at 6.46%, and the forward PE is sitting right around 10 times earnings, which makes it pretty cheap, especially for a company that has the ability to keep growing over the next 5 to 10 years. So when we look at Rio Tinto, Schwab has it as a B rating, Morningstar has it as a 4-star rating, and this seems to be a pretty significantly undervalued stock when we look at all experts here. In fact, Morningstar believes this valuation should be closer to $75 a share. This one is very interestingly positioned, and I actually like the fundamentals a little bit better than some of the other miners out there. And I like the fact that the portfolio is well diverse and they can still be a massive player when it comes down to lithium mining. So this is going to be one of the top ones on the list. The nice thing about this acquisition, it was an all-cash deal, so I really like how this company is now positioned. Stock number two is one that I've mentioned many times on the channel. It is my largest holding, and I talk about it probably way too much, but I do think that this quarter is going to be a make or break quarter for Pfizer. Much like Rio Tinto, Pfizer does pay a fat dividend. Now, if you're not catching on to what's taking place here, the reason why I'm making this list is I believe the companies I'm mentioning not only have offensive opportunity, meaning they can grow, but they're very defensive in nature as well. And so Rio Tinto and Pfizer are on the list. Now, Pfizer, as I stated, is going to be a make or break quarter for them. We really need to see stuff coming through their pipeline, some optimism, because right now we're starting to see activist investors now start circling this company as it's been a massive underperformer and it looks like it's undervalued. Some crazy stuff going on with Pfizer, and I don't think the story's dead, which is causing it to kind of sell off here. Now, if you're new to the channel, I recommend Pfizer right around $27 a share, ideally under 27, and you can use options to kind of work into these positions and collect a premium on that. But this is definitely one I think you want to have in your portfolio over the next 5 years. It's been a massive underperformer, but I think there's brighter days ahead for Pfizer. And I also think they're going to be cleaning up this balance sheet with the recent equity sales that they just had. Once again, trading at 11 times earnings, very reasonably priced, fat dividend, and a big opportunity for growth ahead when we talk about possibly being one of the largest players to cancer remedies. So these are companies that I think the market's discounting that have growth opportunities and are extremely cheap, but of course, cheap doesn't make them a buy, and both of these are going to be more of a 3 to 5 year play. So if you're looking for a quick return, these are two companies I probably wouldn't recommend. Now, the next stock I did recommend, and I still think it's sitting in an interesting territory. This company was trading for $14 a share, now trading for $20 a share, and I'm talking about Barrick Gold, another miner. Mainly focused on gold and copper, has made some really nice acquisitions that I do think are going to pay off. And when we look at the price of gold, if you're a gold bull, then you must be a gold miner bull, and they haven't really performed that well. Yes, the stock's up 32% over the last year, but gold's up 45%. The company's trading right around 9 to 10 times earnings, pays a 2% dividend, I don't recommend buying it at these levels. I would actually wait for a substantial pullback in gold, which then would impact gold miners and a company like Barrick Gold. And I'd be trying to get the stock underneath $17 a share. All these companies are very volatile in price, but if we look at the projections of future growths, I think all three are reasonably valued and have dividends and have growth opportunities ahead, doing a couple different things for you. Not only are you getting paid to wait, but you have growth opportunities, and I do think all of these are defensive in nature. For Barrick Gold, seems like it might be in fair territory when we look at Schwab rating as a C, Morningstar as a 3-star rating, CFRA has it as a 4-star rating. And so I do think it needs to come down a little bit here, but I am very bullish on Barrick Gold longer term, especially if you think gold prices are going to remain above $2,500. Now, if it breaks above $3,000, you have an absolute monster, I think, for a growth opportunity in Barrick Gold. When we look at where Morningstar believes valuation should be, around $22 a share, which means there's not a tremendous amount of upside, and that's about what I think for the stock as well. So that's why I do think you need to get it on a pretty good pullback here. This next stock, I've been waiting for a pullback in, and it just doesn't ever seem to get there. It's going to be ticker symbol KR. That's going to be Kroger. Kroger is going to be one of the largest grocery chains out there. They're starting to do more home deliveries, and I think it's fairly undervalued when we compare it to its peers. Don't love the sector that it's in because this is a low margin business. When we're talking about grocery chains, believe it or not, we're talking about less than 2% margins, sometimes even less than 1% margins, which means there's not a lot of room for error. But at the same time, when we talk about a company that is growing, they have some possibilities to kind of scale up here. Is a 2.3% dividend, still fits in that defensive sector, but also has the growth opportunity as well. So you guys are kind of seeing the commonality here of what I'm trying to bring to the table when I talk about these stocks that I'm breaking down. Kroger trades around a forward PE of 12 times earnings. Now, we're looking at something like Walmart trading at a forward PE of 31 times earnings, or even a Dollar Tree trading at a forward PE sitting right around 12 times earnings. To me, I would rather be in a company like Kroger, who pays a dividend, who's actually growing and not dealing with all the headwinds of these discounted retailers that are dealing with. So when I look at Kroger, I think it's a nice setup, but I need a pullback. How far do we need to get in? How far of a pullback do we need to go in order to see Kroger kind of be in a buy territory? Between $40 and $47 a share is ideally where I'd want to get in on this stock. Outperformer as an A rating and in the 8th percentile. So very, very strong recommendation for Schwab. When we look at Morningstar, Morningstar gives it only a 3-star rating. This is about what I would give it as well. I tend to align with Morningstar in a lot of different stocks. And they believe fair market's probably sitting closer to $57 a share. I would say that's about right, 57 to 60 bucks a share. And that's why I personally would want to get it around 45 to 40 bucks a share. Now, this next stock is starting to possibly hit my ideal price target between $40 and $49 a share. And what company are we talking about? Well, the last stock on this list is going to be Etsy. Now, I don't know if people remember this, but this was nearly a $300 stock during the pandemic, now at $49 a share. And I do think it's sitting in some interesting territory here. At these levels, I would not be surprised if this thing gets acquired. I don't know if there's that much more downside risk to Etsy. We have a high of $105 and a low of $45 for Etsy. So I do think it's starting to hit on value territory. And this is about where I would be very interested in acquiring some shares. I wouldn't take on a ton of position on this one because they're projected to do right around $2.81 of earnings in next year's earnings report. And with 4% revenue growth, that would put them over $3 billion of top line revenue. So even if we just do some quick paper math here, we take that $49 divided by the $280 that they're projected to do next year. That puts them at 17.5 times earnings and a pretty clean balance sheet on this company. One thing I do want to highlight is they are getting a high return on invested capital of over 12%, as they have cash and cash equivalents are sitting around $1 billion, and they only have about $2.3 billion in debt. Has a unique opportunity, and the valuation is definitely getting reasonable, and they are doing a good job of deploying capital. I do think it needs to come down a little bit more. When we look at Schwab, they give it a C rating. That's about what I would think too. That means it's probably going to be a market performer. Morningstar actually has a 4-star rating and a wide moat for Etsy, which I don't know if I tend to agree with that. They believe the stock's fairly valued around $100 a share, and they did this analysis in August when the stock was trading around $60 a share. I'm sure they'll go back to the drawing board and revamp all this, but even so, they do think that this stock has a pretty substantial upside move in it. Personally, I think it's an interesting stock below $45 a share. But I do think that they do have a somewhat of a moat here with the unique products that they're able to sell and connecting the consumer with the creators. So I really do like that aspect. And I do think that this is a company that could be acquired pretty cheap when I look at something like maybe a Meta or possibly even collaborating with a Pinterest. So I think there's opportunities for Etsy to kind of get plugged into another company here and really grow revenues. I don't think this story is dead for Etsy, but I also think it's in a very, very competitive market. So as always, guys, appreciate your time. Hopefully you enjoyed this style of video. Let me know in the comments if you like this or if there's any other stocks you guys want me to start looking at. As always, guys, appreciate your time and we will see you in the next one.